We are hearing these numbers that trillions of dollars are coming to the US. Most people might not know what does this mean, how does it impact growth, or how does it impact the economy here. Can you tell us how would it work when a lot of capital comes into a country?
Sure. When we think of the capital that's being invested, a lot of it's in technology. Chips now being manufactured back in the United States. Apple's doing more assembly and work in the United States. You've got more capital going into the energy sector and so forth. So if you think about it, if you're buying equipment and you're putting that equipment to work, you need to hire people. That goes into a business, and they invest that into the company. So you have to buy those from someone who makes it, and then you've got someone who installs it. Then you have someone who services it. Then you create someone who has to run those equipment and machines and so on. And then that person lives in that area, which is growing and expanding. So then you need more restaurants and more retail establishments. So you basically need a whole infrastructure. If that person has children, they need to go to a school. You need to have healthcare, hospitals. So when capital starts to get invested, it starts to multiply throughout the whole economy. And particularly if it's going into hard assets like equipment, manufacturing assets, those will be around for a long time, and they will continue to compound in value. So generally speaking, if money is going into resources or manufacturing, economists, back of the envelope, for every dollar that gets invested, that can create up to $3 in GDP growth over the next couple of years. That's substantial. So when President Trump talks about 18, 19 trillion coming into the country, even if it's 3 or 4 trillion a year, because some of that is not, of course, just this year, that's going to be spread over a number of years. But if you're talking 2 or 3 trillion dollars coming in, that starts to create a multiplier of 6 to 9 trillion over the next number of years in terms of growth. And when you're on a $30 trillion economy, you can see that it doesn't take long for that to add 5 or 6% to your base. This is really tremendous. The other thing about productivity is that you can get, when you invest in more technology, even AI, every dollar will produce more outcome, a more economic outcome. So if you just use an arbitrary example and say for every dollar you invested back in the 50s, you might get $1.20 or something, $1.50 out of it. If you're getting increasing productivity, instead of getting $1.50, you'll get $1.80. For every dollar, you'll get more economic growth and more economic growth. And we're seeing that with AI and the technology, that's exactly what's happening. You're getting an increasing multiplier effect. So less inputs in to get more output. That means a lot of times people are talking about all this inflation problem. Well, the best way to solve inflation is to produce and manufacture and invest. And if you produce more, you'll bring the costs down over time, and you'll also create more supply. We've been awash in the West with this whole redistributory economy, right? So instead of focusing on production, we focus on how we're going to redistribute it. But if you don't produce, as you know, you can't redistribute very much. That's why if you grow the economy, you'll also take care of the inflation side of it over time, which is critical.
You brought up inflation. What are your thoughts on where inflation is headed? This is a hot topic for a lot of people have been discussing it because prices have been going up, and the Federal Reserve just cut the interest rates, and some people are saying that's not the right decision. What are your thoughts?
It's a tough one because what you've got here is you have a global economy that is grossly indebted. And so we've been living beyond our means virtually right across the globe, whether in Europe or in Japan, China, United States, Canada. All of the countries have been living beyond their means. And so we've accumulated a large amount of debt. We've overspent. We've spent forward a lot of our assets. So what does that mean? That means that how are we going to control the debt? How are we going to deal with the debt? And the way that we've been dealing with the debt, especially over the last number of years and through COVID, is by printing money, adding more money to the money supply. Because to carry a $350 trillion debt globally, that's the kind of numbers we're talking about. And remember, that number would have been maybe 80, 90 trillion 26 years ago. So you've had a massive, massive uptick in debt. To carry that, you've got to keep interest rates quite low. And in some cases, it's impossible to basically get everybody to buy all those bonds that have been issued. And so what do? You get the Federal Reserve in the case of the United States, or the Bank of England in the case of England. They start buying with printed money that's it's just new in circulation. That puts prices up. That's what we saw, especially through COVID, when government shut down production and they just filled it with new money. Well, you're throwing money and you're not producing as much, prices are going to go up. So trying to get out of this loop is difficult. And I think there will be more inflationary pressures simply because there's going to be pressure to add to the money supply because the debt's so large. That's why I think what the Trump administration is trying to do, you have to do something. And I think that something is, let's reignite our economy. Let's get growth going. At the same time, you've got problems on the debt side. Those are going to have to be pulled into line. And you're going to have to deal with a little bit of inflation. But one way to deal with that is to produce, and try to get wages up so that people can actually afford these items. So I think inflation will continue to be a challenge just because there's so much debt, and central banks around the world are adding to the money supply in order to keep solvent. That's why a lot of investors are, I think, starting to look at gold, silver, precious metals, hard assets. Why have they gone up so much over the last little while? Well, there's a host of reasons, but certainly one of them is a concern over the value, purchasing power of your money, the value of our fiat currency. And I still think the US dollar is one of the strongest in the world, although it has serious problems. It's just that if you look at other countries, would you really want to own the pound? Would you want to own the euro? Would you want to own the yen? Absolutely not. What I mean is in comparison to the US dollar. But and that's why I think people are looking at the gold, the silver, platinum, palladium, some of the other precious metals in terms of value and hard assets.
You mentioned gold and silver and these precious metals. They have had a significant move in the last year. What are your thoughts on that? What do you think of gold and silver at this stage?
Yeah, it's a great question because silver was up 130% last year. That's a big move. Gold was up, almost 70%. That also is a big move. And in the year before, gold was up 25% or so. So you've had some substantial moves in the prices of the precious metals. But a couple of things. What I tell our investors is, yeah, it's gone up a lot, but what are the factors driving the gold and silver? And have those factors dissipated? Have they disappeared? Are they no longer relevant? And looking forward, are some of our concerns in terms of our money and purchasing power, are those still in place? That's why I continue to hold the gold, silver. We continue to add strategically to some positions if we think they're cheaper than others. And we encourage investors to dollar cost average carefully into the market. Just don't jump in with both feet, but just dollar cost average into quality investments, quality positions that can give you some exposure. The bottom line is the debt's too large around the world. The debt's intractable. It's not going to be dealt with without pain at some point. We just can't, we can continue to print money, but then you want to own gold and silver, it's going to continue to go up. I would argue that gold and silver have been held back over the last number of years. So what we've seen over the last year and a half, 2 years, is a bit of a catch-up from undervaluation and lower prices, and especially in the case of silver. Silver is a very intriguing one, and I'm not about to tell you where silver is going to go other than I think it goes higher, much higher. But silver is one that has been depressed quite a bit, and it's become quite low in value relative to gold. In fact, it hit 1% of gold, and that's highly unusual. Whenever it does, it usually bounces up to about 3%. So 3% on, you can do the math on 4,500, then that'll take you up in the mid-hundreds dollars for silver. Currently, it's trading just under 80. But silver has become really strategic metal too. There's a lot of demand for silver. This is one of the things I think investors should be looking at, is the whole AI issue and the whole data center issue and the whole robotics and digitization. That's turning our energy needs into growth again. And we haven't seen a lot of growth in our energy demand because we've become more and more efficient. So we haven't had to increase our energy capacity as much, even though our economies have been growing. But with the data centers, digitization, robotics, all of this, our energy demands are growing. And that's why power is critical. And this is, again, one of the reasons why Donald Trump wants the Chinese out of the Western Hemisphere, and he wants to control the energy reserves within the Western Hemisphere, including Venezuela. Silver is critical going forward for the power energy and as a conductor. And we're going to need a lot more silver. And the bottom line is the last 5-6 years, we are not producing enough silver to meet the demands. And that's just going to get worse. And silver is not easy to come by. Only about 18% of silver actually comes from silver mines. The rest of it comes from copper, nickel as a byproduct out of the other mines. So I think silver is an intriguing one. So investors should just stay put and dollar cost average into that. And copper also is going to be very important because we're going to need about a 70% increase in copper in the next 20 years or so if we continue to build out the data centers. Even this morning we saw Meta, Facebook, Mark Zuckerberg doing big deals in the nuclear space. He's locking in nuclear energy. Someone said that the amount of energy that he was locking in, I haven't had a chance to look at it in detail, was equivalent to 6 cities the size of Chicago.
Wow.
So that's a lot of energy. So that's why I think people need to stay along some of these commodities. But be careful. I mean, they can be volatile. You have to have a strong stomach and you have to take a longer term view.